Kura Capital Limited, a non-banking finance company classified under the scale-based regulation framework, is required to maintain a minimum capital adequacy ratio of 15% of its aggregated risk-weighted assets and the risk adjusted off balance sheet items. The company has provided the following financial data for computing the Tier 1 and the Tier 2 capital as per the RBI Master Circular. So now what happens? They have an own funds of 1,000 crores. They have investments in the shares of other NBFC in the group companies, which is exceeding the 10% of the owned funds actually here. So there is 150 crores. Perpetual debt instruments issued by Kura Finance Limited 120 crores. Preference shares not compulsorily convertible into equity 80 crores. Revaluation reserves 200 crores. General provisions and loss reserves 50 crores. And hybrid debt capital instruments 90 crores. Subordinate debt is around 140 crores. Revaluation reserve is around 200 crores. General provisions and loss reserves are 50 crores. And subordinated debts are 140 crores. The risk weighted assets is around what you can say 8,000 crores. So considering that the Kura Finance, if we talk about this particular NBFC Kura Finance, so is what you can say not a microfinance institution, and it is not lending against any gold jewelry. You have to compute the Tier 1 capital of the Kura Finance Limited as per the RBI guidelines, and Tier 2 capital ensuring that it does not exceed the Tier 1 capital. So you have to determine whether the Kura Finance Limited meets the minimum capital adequacy requirement of 15% of the risk-weighted assets. Okay, so that's the thing here. So this is nothing but it is talking about the capital adequacy norm. That's the thing here. Okay, so now basically what happens, you have to determine whether Kura Capital Limited is meeting the capital adequacy requirement. So first of all, we have to calculate the Tier 1 capital and the Tier 2 capital, and then we have to calculate the ratio, compare it with the 15% of the risk weighted assets. Now first one, Tier 1 capital is basically the own funds minus the investment in group entities plus eligible perpetual debt instrument. Okay, so Tier 1 capital, so you have the 1,000 which is the own funds, and the investment in group entities minus, that is 150. Okay, now coming up to eligible perpetual debt fund, actually perpetual debt instruments are limited to 15% of the previous year's Tier 1 capital. Assume 120 qualifies, so we include it as a Tier 1 capital. That's the thing here. So 1,000 minus 150, that is related to investment in group entities, plus 120, so it comes to 970. 970 is the Tier 1 capital. Then we have to calculate the Tier 2 capital. Tier 2 capital, basically it's a sum of the preference shares, which is around 80 crores. Revaluation reserve at 55% discount rate, that is 200 crores into 55%. So it comes to what you can say 110 CR. Then general provisions, which is limited to 1.25% of the risk weighted assets. So 1.25%, that is 8,000 crores, which is like say 100 crores. So the actual general provision is 50 crores. That's the thing. Then we have to take it as a 50 crores. Then you have hybrid debt capital instrument, which is coming up to around what we can say the 90 crores is the hybrid capital. That's the thing here. And also we have subordinated capital, which is like say 140 crores. Perpetual debt instrument exceeding the Tier 1 limit is around the is nil actually here, because already we have taken the perpetual debt instrument in the Tier 1 limit actually. Okay, so the Tier 2 capital will be the sum of the preference share capital, the revaluation reserve, a discount, then general provisions, hybrid debt capital instrument, subordinated debt, perpetual debt, but it is not considered. So this comes to totally 470 crores. So Tier 2 capital cannot exceed Tier 1 capital. So 470 crores is within the limit of because 970 crores is the Tier 1 capital, so it is fully eligible. Now we have to compute the capital adequacy ratio. Capital adequacy ratio is the total capital, that is Tier 1 capital and the Tier 2 capital. So the total capital is comes to 970 plus 470, it comes to 1440 crores. So the capital adequacy ratio is the total capital divided by the risk weighted assets, which is say 1440 divided by 8000. Now this comes to approximately 17.5, and the minimum capital adequacy ratio is 15%, but already the NBFC has around 17.5%. So they are well above the requirement of the capital adequacy ratio. So in this case, actually here there is no issue, there is no violation as such. So they have definitely complied with the capital adequacy ratio. So do they have a sufficient capital to do the business? That is what you have to look into. I'll see you in the next video.